For years, there's been a conversation about whether millennials will ever get to buy homes.
The good old days of 2.5% mortgage interest rates are gone.
And now we're talking about the idea of the average home buyer is 40 years old and we might need 50-year mortgages for us to be able to get homes affordable.
Now that Trump is talking about reducing rates and bringing mortgage rates down to spur home buying, that maybe there's a couple of really interesting opportunities to look at.
Check out today when we talk about that, and we talk about two companies we think could be big beneficiaries if the home market gets unlocked today on Altimetry Authority.
Let's talk earnings and favorite pastimes.
So let me just say, earnings
Wall Street
That's
2.5x
because their compensation goes up.
Wall Street's wrong again.
The headlines for home buyers have been just depressing for the last few months. First, you had earlier this month, U.S. median first-time homebuyer age is now at a record of 40 years old. And then in the middle of the month, we had the administration floating the idea of us going to a 50-year fixed rate mortgage from 30 years. You just want to talk about what that does in terms of tying people up, in terms of just cost for forever. If that's the only way that we can basically get cost to affordability, it's a scary time to be out there. And, in fairness, everybody, this is not an issue that just cropped up in the last year or two. This is a great email that was between Peter Thiel and Mark Zuckerberg all the way back in 2020, before COVID hit, where they were having a debate about, what is going on with their primary consumer, Millennials and Gen Z and beyond. And what Thiel highlighted, which was really interesting, he said, look, from the millennials' perspective, sure, you could dismiss it and be like, well, they're stupid, but let's figure out what's going on in terms of why, because maybe they're not. Maybe there's a justification for their feeling. And their issue is, right, a lot of them feel like they've had a broken generational compact. They are never going to be able to buy a home, right? Like literally 40 years old for the average home buyer. They're saddled with too much student debt. They've got negative capital. And so it's next to impossible for them to dig out of it. Maybe there's a reason why they're mad. And if you really want to, though, talk about this issue, the issue specifically for home buyers, which, for America specifically has always been, the lodestone of the American dream of, you've made it into adulthood when you can buy that home. Well, there's two big factors that are creating the issue right now. The first is the one that everybody wants to talk about, which is median sale prices of homes. But if you want to talk about median sale prices of homes, this chart right here actually does not matter for a home buyer. It doesn't. Because this is only one half of a very important equation for any home buyer. Because the other half of that equation is this, which is the 30-year fixed rate mortgage rate. And you can notice when that house pricing chart was going up from 1980 until 2020, a big explanation is this chart here. And, it's wild that we have never seen anybody talk about these two charts in the context of this chart. Because what this chart is it puts into context what matters for everyone. Because when you go to buy a home, yes, obviously you need to think about a down payment. But the fact of the matter is, over the last 30 years, the innovations we've had from getting away from 20% down is what you need to have, in terms of FHA loans where you can have 5% down, in terms of buying mortgage insurance if you can't get the whole entire down payment, or any other thing, is the down payment doesn't matter. What matters for everybody is the cost to carry for the home. How much does it cost you on a monthly basis to be able to buy a home? And so what we did is we did very, very simple math. If you want to understand how to actually calculate a mortgage payment, it is a payment math from here's how much you put down for it, here's how much it actually, the whole entire value of the mortgage is, here's the interest rate you're paying, here's the number of times you pay it a year. You can do the math. This is the not real, we didn't inflation adjustment or anything. This is the actual nominal dollars out of your pocket each month for paying for your mortgage from 1980 to 2000. Obviously from 1970 to 2000.
Yeah, other than the 1970s stagflation era where, went from like $300 to $800 in terms of mortgage payment. I mean, this is on an inflation-adjusted basis. This is the cost of home ownership falling in real terms, because wages have been up a lot more than that. And the dollar in 2001 was clearly, right, worth a lot less than the dollar in 1980. And so much so that it meant in real terms, the cost of owning a home was falling from 1980 through 2002, 2001.
Because if you do the nominal math here, just the nominal from 1981 to 2001, it was basically flat. Call it $800 a month to like $900 a month. So what happened is, right, from 2000 to 2005, home prices kept on creeping up, right? And then, right, obviously the 30-year mortgage rate kept on falling, which is fine. And then what was really important what happened was, right, what happened in the Great Recession, right? The Great Recession, what happened was the 30-year mortgage after the Great Recession dropped because we basically said, holy cow, we need to solve this issue of, well, everybody's cost of carrying the home had basically stayed flat. The price of homes had gotten crazy and started to come back down. And so what happened was, right, the cost of carrying a home dropped in terms of the interest rate. Well, the median home price came in too. And so what happened was from 2001 to 2007, the actual carrying cost of a home rose, right? It rose from $900 to about $1,300. But then because of that move, because interest rates came down and the price of homes came down too, we got back to where we were basically for all of the 1990s and early 2000s. So the price of a home really didn't change a carrying cost of a home. And this is part of the reason why this was not really a phenomenon, an issue that everybody's worried about in breaking the generational compact. And then what kept on happening? Well, the price of homes continued to recover and rebound from 2013 to 2020, but it did in the context of mortgage rates continuing to drop, right? Mortgage rates dropped in 2013 from 4% down to sub 2.5% levels for some people, right? And so what happened was, even though everything happened in terms of the price of homes, the price of a mortgage did not change, right? This was still a viable option for people to be able to afford homes. But then something really important has happened since 2021, right? What happened? Interest rates went up, right? Interest rates went up dramatically because of the fact that we had our concerns about inflation and everything else. And that led to mortgage rates going up. Mortgage rates went up from a carrying level of, call it 3%, up to 6.5% to 7% is where they have been floating. And yet, when all that happened, the price of houses didn't go down. And so you want to talk about why there's all this teeth gnashing and all this other issues. The reason why is the cost of a really important thing for everybody that basically was almost sideways, and on a nominal basis was slightly up, Joel. On a real basis, to your point, was down for 40 years, has doubled in the span of 5 years. And so look, everybody, we get why everybody is having concerns about this, but there is there is some silver lining in this cloud because of what is actually going on right now. And whether or not you agree with President Trump, one of President Trump's big views is he thinks the Fed needs to lower interest rates. And what he's talked about is that the Fed shouldn't lower interest rates to, basically 3.5% or 3%, which, by the way, as geeks who study economic theory and everything, probably right now, 3.75 to 4% feels about right with where the economy is. But it doesn't matter what we think in terms of where it should be. What matters is the guy who's going to appoint the next Fed chair in 5 or 6 months, in May of next year.
In May, yeah.
He knows where he wants interest rates to go. And if he wants interest rates to go down that way, guess what's going to happen? The 30-year mortgage rate is going to drop. And that means affordability of homes is going to come back. And so, Joel, we picked off 2 companies that we think, they're brokers, everybody that we think everybody is sleeping on because they're looking at the chart how it is now and not where the Trump administration might send this chart for mortgage rates and what that means for mortgage payments. Joel, let's take everybody through Douglas Elliman and EXPI.
Great. Douglas Elliman, the real estate service company. You've probably seen their brands around. Had a great 2021 when people are like, oh, I'm going to be working from home. I'm going to be living at home. And so a lot of people expanded their homesteads. And so, a real estate firm is going to do really well and have a 20-something% ROA when you have that kind of massive, I don't have to go to work anymore. I need to be home. And that means I need more home because we're all on top of each other, right? Which wasn't the case before. But come 2023, you saw them have a really, really bad year. A lot of companies, when they have a great year, they expect it to continue. And sometimes they pick up costs and they don't get rid of the costs as fast as the cycle goes away. Now, in 2024, they're coming back. By 2025, that is the forecast of 2025, it looks like Wall Street analysts are saying it's going to get back to like kind of 2019, 2020 years before the whole giant work-at-home movement occurred. And then, frankly, sputtered out a bit because just rates interest got so high. Now, what's embedded is that this stock is going to continue to have like a 3% return
in
perpetuity. in perpetuity, so that they're never going to get back to the heydays of 2020. Or if they do, it'll be offset by another kind of 2023 where the numbers get really, really bad. And so the cycle average that they're predicting in is 3%. That's what's buried in the current stock price of $2.47 and a market cap around $230 million.
And everybody look at this and right again, we can understand why 23 and 24 were so bad for this. Remember what happened to house affordability, so nobody was buying. They were in a desert, right? A realtor desert, literally. But for you to think, if we're going to have a return, not to boom times of 2021, to your point, Joel, but just to a potential really decent market in terms of buying and selling, that could really actually see ROAs be better here for Douglas Elliman. And the same story is true for eXp World, Joel, right?
eXp World, now this was one of our best stock picks because this basically helps real estate agents do stuff online, right? And virtual home shows and whatever else. I think, Rob, this was our stock pick back in mid-2020, and it did 800% before we... Yeah, June 2020, and it did an 800% return before we closed the position for our clients. So this was one of our best picks. It's beginning to look really interesting again because if real estate's going to pick up, if home buying picks up, Wall Street analysts certainly don't see that happening. They're saying that this company's returns are going to get cut in half from 100-something plus percent to around 70%. And the stock market is saying, oh, no, it's going to get a lot worse than what Wall Street's even showing. And the stock market's pricing in, it'll have maybe a 25% return in perpetuity. That seems quite abysmal for a company that's, now a $1.6 billion market cap, trading at $10 a share. And that maybe this also has some opportunity because even if the company doesn't get back to its heyday 22, 23, all they have to do is just maintain the profitability level that they're getting right now. And that already would mean double or maybe triple in their stock price because the market is embedding, the over-under is that they're going to have a very, very, very continued steep decline, which seems somewhat implausible. It does if we're going to go through another real estate boom because mortgage rates come way down to where Trump is hoping he can push them to.
Especially, right, because everybody, to Joel's point, eXp World, what they're basically a platform for brokers, like that they handle all the back end and do it all virtually and everything else online. And so more brokers means more money for eXp World. And if you get a boom in terms of home buying, you're going to see more brokers, and that's going to benefit eXp, and that's going to benefit Douglas Elliman if you see it play out that way. This might be the way to solve that generational compact breakage that everybody's so worried about. Keep an eye on that. Now, look, you may disagree with us and think that we shouldn't get interest rates cuts or that there's some other solution. If you do, feel free to drop those comments into the comments below, and feel free to hit the like and subscribe button if you enjoyed this conversation, and come back next time. That is this episode of Altimetry Authority. Thanks, everybody.